From the morning reading, small caps gain as 8 sectors and the SPY pull back. 8 of 9 sectors moved lower on Thursday. XLU, XLE, and XLY were the strongest sectors, while XLB was the weakest sector. Oil futures fell 0.19 to close at 38.11. Breadth weakened as advancers led decliners 1.21 to 1 on the New York Stock Exchange and decliners led 1.03 to 1 on the NASDAQ. Individual investors are not buying this rally. Over the past week, the percentage of those expecting higher stock prices over the next 6 months declined even while stocks moved higher and settled at a multi-month high. Typically, declining optimism is bad for stocks, but in this case, optimism is already so low that it led to good returns. It may not seem like it, but the last couple of years have been the quietest in 20 years. The distance between monthly Bollinger Bands of the S&P 500 is the tightest since 1995, a sign to some that increased volatility is coming. But when the bands have squeezed this tightly in the past, stocks have tended to rise, not fall. Quarterly reversals tend to last into the next month. There have been 13 times the S&P 500 lost at least 5% during the quarter and then closed in the upper 90% of its range. The first 2 and 3 days of the next month were positive 12 of the 13 times, both averaging 1%. The positive returns mostly lasted through the first week, after which there was less than a positive bias. If the S&P gained 5% in a month, then the first week of the next month was positive 74% of the time, as opposed to 66% any other time. We don't put a lot of weight on this kind of seasonal window dressing kind of bias, but it's been a popular question. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:04 a.m. Central Time, and I'm recording this in preparation for the market day of April the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And a little bit of weakness overnight, and you see at the time of this cut, the S&P futures were down nearly 8 points, and it's about 8.5 right now as I look over. So that's about 0.4%. Russell futures down a little bit more, heading towards 0.6%. NASDAQ down about 0.4%, and the Dow down about 0.33%. Crude oil, fairly big move in the overnight, down over 2%. Euro up about 0.25%. Bonds about scratch, and then gold down about 0.33%. In overseas action, China up just above scratch. Hong Kong down pretty significantly at about 1.33%. Japan down big at over 3.5%. Germany down about 2%. United Kingdom down about 1.25%. So fairly negative across most of these markets in the overnight. In terms of macroeconomic activity in the United States for today, we have ISM manufacturing, revised University of Michigan consumer sentiment, and before that, I was about to miss the biggest one of the day. Before the market opens, you had the non-farm employment change. That's your regular monthly employment report. That will be the one that will set the tone, likely, for the morning. And let's see if there's anything else. FOMC member Mester will speak about midday, so be aware of that as well. In terms of current market conditions, we have been relatively benign of late. You heard some of the morning reading authors talking about low volatility, and indeed our short-term VIX is down here around the 12 handle. Skew is benign. IV percentiles very, very low. With the S&P at 11, the Russell at a 15, the NASDAQ at a 13, and the Dow at a 7. So very, very low levels here. In terms of standard deviation moves yesterday on a close-to-close basis, there were none. And indeed, we only had one on the S&P in the last 2 trading weeks. So activity has been really quiet during this time in terms of any kind of extreme moves. And let's go ahead and go to the charts and take a look at some of this. So we'll go ahead and use the SPX to start off with. And you see we've had this whole series, I think we counted 1, 2, 3, 4, 5, 6 bull flags, each one continuing higher. Really only the slightest little pauses at areas of prior resistance and empowering on through. So this has been a very, very impressive move, taking us from a little over 1,800 to almost 2,100. This has been just amazing, almost 300 points now in a period that is a relatively short period of time to be able to power that far. We are playing with these levels of former resistance at this area here before the big fall at the beginning of the year, and we'll see if we can tag that. Once we get past that, and then basically the discussion becomes about the former all-time high ranges. There was a number of similar highs all up here around 2,100. In terms of potential for reversal, there's not a lot of evidence calling for it on the chart here, other than the fact that it's just simply so extended. And then at some point you expect a retracement. And even if you got a retracement of about 1/3 of this move, it will seem big given that we have come so far. You know, a 1/3 retracement on a 300-point move is 100 points, and people will feel quite fearful to lose 100 points after the recent 6 weeks. So just kind of keep that all in context. Frankly, even a 100-point drop would not change this intermediate trend in a bullish stance. In terms of the Dow, very similar activity to the ES. They've been marching pretty much lockstep in recent. The big dividend paying stocks of the Dow versus the large cap S&P, especially the S&P 100, have been very much in lockstep of late. Not so much in lockstep has been the NASDAQ, and the NASDAQ has been definitely held back, though is still very impressively bullish. It's just not as much so as the Dow. Remember when we were looking at the S&P, we were playing up here near these highs. You can see the NASDAQ has quite a ways to go to be able to come up into a similar location, nearly 100 points behind, in effect, for the NASDAQ compared to where the S&P would be in a relative basis. And let's take a look at the Russell, and we're coming into a very important diagonal resistance area, and then also just above that, backstopping it, would be this horizontal resistance. So this area between about 1114 and we'll call it about 1160, that seems like a pretty big zone, but that zone right there is likely going to prove to be a pretty significant zone or area of resistance for the Russell. And I suppose if we were to draw lines on the others, we probably would find similar overhead resistance. That's what you have to fight through when you're repairing the damage from a big down move like we've had at the beginning of the year. In terms of bonds, let's see if they're telling us anything. Can't really say that they're telling us anything. They're in the middle of the cloud. They're chopping back and forth. One day just alleviating the day before's action. Really, all you can say here is that it is in a congestion, consolidation phase and waiting to break one way or another. Volatility, trying to tick up a little bit today with the overnight weakness, but nothing really obvious here as well at this point. Still below 18, still in the range of the bull trends, where you like to see volatility in bull trends. And we'll take a quick look at gold, see if there's anything interesting going on there. A pretty complex retracement pattern here. I suppose the best thing we probably would draw on this right now is a channel, and then expect that at some point we'll break out of that channel. So probably to the top side. We're above the cloud. The trend leading into the consolidation was a bullish trend, strong bullish trend. So probably will break out of this channel to the top side. So draw a trend line across the tops here and then look for a break of that area. And with gold, gold can be quite volatile, so be careful about whiplash and false breakouts. A fairly aggressive entry would be to enter just about 10 or 20 cents above, this area here, and then take a position with a defined risk to be able to move forward. So kind of keep in mind on that. Gold is definitely something to watch. These kinds of moves can make you a lot of money, but along the way, gold can certainly chew you up as well. And let's go ahead and go to the daily report. In terms of the daily report, our three market timing signals are in the same place that they were yesterday. IBD, the first one, gives us a confirmed uptrend. The accumulation distribution score is a C on the NASDAQ, a B minus on the S&P. They continue to heal, but they're still not glowingly wonderful by any means. GMI index is glowing. It's at 6 out of 6, a full out buy signal since March the 2nd. And the decision point scoreboards gives us that mixed signal with the short and intermediate term all pretty much bullish, whereas the long term, the most important time frame, is in still a bearish posture. So when you put all this together, consensus is that we are in the short to intermediate term, and in some signals, the IBD signal and the GMI, also in the long term, whereas we've got some lag on the decision point scoreboards for the long term. So overall bias is bullish, but this still is a market in transition until we clear the zones and stack these time frames. So a little bit of caution is still to be exercised. Position sizing opinions both coming in at 100%. Intermediate term market posture still very strongly bullish with a weak sentiment, weekly bullish sentiment line supporting it, and this weak bullish sentiment line continues to improve. In terms of the strength of the trend, of course, it is weak, but significantly improving. Our hedge warning status is level 0 plus normal with some elevated risk conditions, and we'll talk about those elevated risk condition specifics in just a moment. In terms of specific strategy opinions, everything's green here. In terms of option income strategies, cover call strategies, put selling, all are acceptable for the initiation of new positions for novice and aggressive traders. You will note that we are suggesting a number of still somewhat defensive postures and how we construct these cover calls using a ratio of in the money and out of the money strikes, a ratio of low beta and high beta positions, and then legging into some of the positions through selling of out of the money puts. In terms of the put selling, make sure that you have defined risk positions and you position size in the scale that you're willing to own. Remember, that long-term posture was still bearish, so you've got to be prepared for the advent that you might end up owning those shares and have your position size set that way. In terms of specific warnings, that volatility ratio warning, this has actually been a bit unusual in the number of days that we have been outside that threshold there before firing a signal and coming back within. So that still is present. And then we still have this with the risk aversion indicators, all 5 of those still flagging as risk off. And then we also have sentiment that has been in the relatively extreme area, not super. I mean, these are 7 on a scale of 1 to 10. They're not an 8, 9, or 10. And indeed, even at that, sentiment can be very extended for extended periods of time. So really all it does is it raises our antenna to say, be on the lookout for potential reversal patterns. So that's what we're looking for at this point. But short-term and medium-term stocks at a 7, bonds also at a 7. In terms of specific signals, LQD also. In terms of fear and greed index, another sentiment indicator, which is a composite of 7 different fear and greed indicators. You have an overall score right now of a 73, so a bit higher from yesterday and certainly higher than a week ago and a month ago. Higher is, an advent of being super bullish, and that is seen as sometimes a contrarian indicator that when all are bullish, it's time to go bearish. In terms of intermediate term market postures, we've got here, you see just a sea of green. Many of these are all out intermediate term bullish. You notice dollar is neutral. In terms of the sector percent change, pretty much a sea of green here with a couple exceptions. Energy and then materials. Materials was just barely neutral. And those 2 sectors are perhaps the weakest of all the sectors at this point. So kind of keep that in mind. In terms of percent change yesterday on a down day, guess what? The defensive one, the utilities, was the one that was up. It was up nicely at about 0.5%. And you see, if you look at the 3-month performance, who's at the top? Well, utilities and telecom. Also a defensive area where you have just a handful of companies with big, fat dividend yields. And clearly, that's where the performance has been thus far. For even here, you look at the year to date, that's where performance has been, the defensive postures. I noticed with some of the commentary yesterday with the closing of the quarter, and of course the Dow was up just barely, the S&P was up even less so, just barely for the first quarter. Well, that's not true if you had been invested, as we've been talking about, day after day during this quarter, with an overexposure to these big dividend paying companies. Your performance would have been significantly better than just break even for that first quarter. And I think that's enough for today. Let's go ahead and go into our wrap-up sequence. And let's see what we might want to talk about here. Well, on the YouTube, a couple things here. These videos typically go about 20 minutes, so always be aware that, first of all, you can subscribe to the YouTube channel, and we greatly appreciate it when you do that, but you also get some benefits from that. First of all, subscribing is free. It doesn't cost you anything. It basically just sets you up to be notified when content has been posted. Also, when you play that back from the YouTube channel, you can go to that little gear button, and once you hit that gear to access the settings, you can make sure that you're watching it on high definition. And when you watch on high definition, the charts and so forth will be much clearer. The other thing is that you can play back the video at about 1.5x. Now, you can move this up or down according to your own liking, but most of the time you'll find that about 1.5x you can still fully comprehend what I'm saying, and yet at the same time play that video back in something like 13 minutes instead of 20. Other offerings here. And if you have more interest in one of these specifically, just take a look at the hyperlink for greater details. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the full set of disclosures from the hyperlink down here at the bottom. We'll see you back here on Monday morning for the Falcon Global Market Preview. Good trading, everybody.